Every business, big or small, keeps score using three main reports. The income statement is like your report card. It shows if you earned more than you spent. The balance sheet is a snapshot in time. It lists what you own and what you owe. And then there's the cash flow statement, the one that answers the most real question of all. Do I actually have money in the bank to pay bills tomorrow? Understanding these three reports sets the stage, and today we're focusing on the most critical one: cash flow. Cash flow is the heartbeat of your business. You can show a profit on paper, but if there isn't cash in your account to cover rent, payroll, or loan payments, you're in trouble. Healthy cash flow means stability, growth, and peace of mind. It gives you room to hire, expand, market, and survive downturns. That's why we'll spend the rest of this video breaking down what cash flow really is, how to measure it, and how to use it to make smarter decisions. Okay, before we dive into cash flow, you need to understand that your accounting method changes how you see your finances. There are two accounting bases, which are cash basis and accrual basis. Under cash basis, you record income only when it's received and expenses when they're paid, very straightforward. Accrual accounting, on the other hand, records income when it's earned and expenses when they're incurred, even if no cash moved. This gives a bigger picture but can make you look profitable while your bank account is empty. By the way, businesses making over $25 million a year or C Corp with inventory must use accruals. And even smaller companies may need accruals if they want bank loans or investors, since it's the GAAP standard. This is where so many entrepreneurs get blindsided. Profit is just a calculation on paper. Cash flow is the timing of money in and out of your account. Imagine invoicing a client $10,000. You may show profit right away under accrual accounting, but if they don't pay for 60 days, you don't have cash for payroll tomorrow. That's why cash flow is the real test of business health. Now, let's break down how cash flow is actually organized in your financial statements. There are three main sections, and each one tells a different part of your story. First, operating activities. This is the core of your business. The money you earn from sales, the cash you pay for payroll, rent, utilities, and taxes. If your operating cash flow is consistently positive, that's a strong sign your business can sustain itself from its day-to-day work. Next is investing activities. Don't think of this as Wall Street investing. This is about your own business investments. It includes buying or selling property, equipment, or even other businesses. For example, if you run a bakery and you purchase a new oven that shows up here, it's not an everyday expense, but it's an important signal of how you're using cash to grow. Finally, financing activities. This is money related to funding your business. Did you take out a loan? Did you pay down debt? Did you distribute dividends to owners or bring in new investors? Those inflows and outflows are tracked in financing. So when you put it all together, these three sections answer three critical questions. Is my business generating enough cash on its own? Am I spending wisely on long-term investments? How am I funding or repaying the money behind the business? Looking at all three helps you see not just how much cash you have, but whether your business is healthy and sustainable. Now let's talk about how a cash flow statement is built. There are two main methods: the direct method and the indirect method. The direct method is just what it sounds like. You literally list out every cash inflow and every cash outflow during the period. Money in from customers, money out for rent, money in from a loan, money out for payroll. It's very straightforward and gives you a crystal clear view of what's happening. The indirect method is a little trickier, but much more common. It starts with your net income, your profit from the income statement, and then it makes adjustments. Why? Because profit doesn't equal cash. For example, depreciation lowers profit but doesn't use up any cash. Same with accrued expenses, they affect profit before the money actually moves. So the indirect method adds back non-cash items and adjusts for timing differences like receivables or payables. Think of it like this: the indirect method is your GPS. It takes you from the profit number on your income statement and navigates you to the real cash number in your bank account. That's why it's the method most accountants use. It connects the dots between your reports and makes sure everything ties together. Cash flow is one of the best health checks for your business. If your operating cash flow, the money generated from your core activities, is consistently positive, that's a great sign your business is financially stable. If it's consistently negative, That's a warning sign that you're spending more than you bring in, which can't last long. This is exactly what banks and investors want to see, not just whether you're profitable on paper, but whether your day to day operations are producing steady cash. In a way, operating cash flow is like your business's vital signs. If it's strong, you're in good shape. If it's weak or negative, it means something deeper needs attention. But operating cash flow isn't the whole story. There are a few more cash specific metrics that give you an even sharper picture of your financial breathing room, and that's what we'll cover next. Let's zoom in on three metrics every business owner should track. First is free cash flow. This is what's left after you pay your operating expenses and reinvest in your business, things like replacing equipment or upgrading tools. Free cash flow is what you can actually use to expand, pay down debt, or take distributions. It's a true measure of your flexibility. Second is your burn rate, how quickly you're spending down cash reserves. If your business spends $15,000 more than it brings in each month, your burn rate is $15,000. Tracking this helps you see if your business is sustainable or if you need to adjust quickly. And finally, your runway, how long you can keep going at your current burn rate before cash runs out. For example, with $90,000 in the bank and a burn rate of $15,000 per month, you've got 6 months of runway. Runway is especially critical for startups or businesses trying to scale because it tells you how much time you have to course correct, raise funding, or boost sales before the cash is gone. Together, free cash flow, burn rate, and runway are like the dashboard of your car. They tell you not just whether the engine is running, but whether you've got enough gas and how far you can go before you stall. Now that we understand how to measure cash flow, let's talk about the common traps that cause businesses to struggle. One big one is late customer payments. Maybe you send an invoice, but your client takes 60 or 90 days to pay. In the meantime, you're covering payroll and bills out of pocket. That gap between invoicing and collecting is one of the most common causes of cash crunches. Another is too much money tied up in inventory. Let's say you buy $50,000 worth of products expecting a big sales season, but sales come in slower than planned. Until that inventory sells, your cash is locked away on the shelves. Overestimating sales growth is another pitfall. If you assume your sales will jump 30% next quarter and spend accordingly, but the growth never comes, you're suddenly short on cash. Then there are seasonal swings. Retail stores after the holidays, landscapers in the winter, or tax preparers in the off-season. Revenue slows, but expenses keep rolling in. And finally, heavy debt burdens. Loans can help you grow, but if your payments are too high, they can eat up your cash flow, leaving little room to maneuver. The key is not just knowing these risks, but spotting them early. That way you can adjust before they drain your business. Let's make this real with three quick stories. First, picture a service business, like a consulting firm. They land a $50,000 contract. Great news. But if the client doesn't pay for 90 days, the firm still has to cover payroll and office costs. On paper, they look profitable, but in reality, they're scrambling for cash. Now imagine a retail store. They may show $100,000 profit at the end of the year, but during slow summer months, sales dip. Rent, payroll, and utilities don't stop, so cash flow turns negative. Without reserves, they could run out of money before the holiday season picks up again. And finally, a manufacturer buys a $200,000 machine to improve production. It's a smart long-term investment, but it wipes out their cash in the short term. If they don't plan carefully, they could be cash poor even while building for the future. Each of these examples shows how cash flow problems aren't just about failure. They can hit even profitable growing businesses, which is why cash flow planning is so essential. One of the simplest ways to improve cash flow is to speed up what's coming in. That starts with invoicing. Too many small businesses wait until the end of the month to send invoices. Send them as soon as the job is done, the clock starts ticking earlier, and you get paid faster. Next, ask for deposits or partial prepayments. If you're doing a large project, it's perfectly normal to require 30% or 50% upfront. This ensures you're not funding the whole project out of your own pocket while waiting for the client's check. Offering early payment discounts can also help. Something like 2% off if they pay within 10 days instead of 30. Yes, you're giving up a small amount, but the faster cash flow can be worth it. And finally, make it easy to pay. Accept credit cards, ACH transfers, digital wallets, whatever is most convenient for your customers. The fewer barriers to payment, the quicker money lands in your account. These small tweaks can shave weeks off your receivables cycle and give you breathing room. The other side of the equation is managing what's going out. Start by negotiating longer terms with vendors. Instead of paying in 15 days, can you stretch it to 30 or even 45 days? Many vendors are open to this, especially if you're a good customer. Next, time your expenses strategically. For example, don't pay all bills the moment they arrive if they're not due for another 2 weeks. Schedule payments closer to the due date so cash stays in your account longer. Using a business line of credit can also help smooth cash flow gaps. Just be careful. It's a tool, not a crutch. Ideally, you borrow short term and pay it back quickly, not rely on it to fund your entire operation. And lastly, always keep business and personal expenses separate. Mixing the two makes it harder to see where your money is going, and it often results in cash slipping through the cracks. Controlling outflows is just as important as boosting inflows. Together, they put you back in control of your cash position. Here's where cash flow management moves from reactive to proactive. Forecasting. A cash flow forecast projects what your inflows and outflows will look like over the next 12 months. It doesn't need to be fancy. Even a simple spreadsheet can do the job. The goal is to map out when cash is expected to come in and when major expenses are due. With a forecast, you can spot shortfalls in advance. Maybe you see that 3 months from now, your expenses will outweigh your inflows. Now you've got time to adjust by pushing marketing, delaying a purchase, or arranging a short-term credit line. Think of forecasting like checking the weather. If you know a storm is coming, you grab an umbrella. Cash flow forecasting gives you that same advantage. You can prepare for financial storms before they hit. To close this out, remember that profit is just paper, but cash flow is survival. Businesses don't fail because they lack profit. They fail because they run out of cash. That's why it's critical to monitor your cash inflows and outflows regularly, forecast ahead, and make adjustments before problems snowball. If you found this helpful, check out my other videos to keep building your financial toolkit. And don't forget to subscribe so you'll never miss tips that could save your business money and stress.